What's going on? How's everybody doing today? It's a little bit rare for me to do a webinar during the day because I'm a very active trader and I trade a lot during the day. So throughout this presentation, I might be trading in the background here. You might see me flagging unusual option activity, institutional order flow in the option market. Someone said I'm a fast talker. It's because I have a lot to teach you guys, and I want to be able to teach you guys as much information in a short period of time. So sometimes it is true I talk a little bit fast. So this is Floor Trader Secrets. This is Confessions of a Professional Option Trader. I will be your presenter today, and my name is Andrew Keene. If you guys have any questions, feel free to ask questions throughout the presentation. So a little bio about myself. I was a floor trader at the Chicago Board Options Exchange for about 10 years. Down there, I got trained by Botta Capital Management, B-O-T-T-A, and they taught me basically how to trade. And the big thing we traded on the trading floor was institutional order flow in the option market. So throughout the course of the day, I watched to see if there's call activity or put activity that is outside of the realm or the norm. I'll give you guys one right now for free. Alcoa, AA, somewhere in the world, bought next week 44.5 calls for 35 cents. Okay, so Alcoa, there was a signal today, institutional order flow in the option market of someone buying Alcoa calls for next week. We never know if a trader is speculating or hedging their position, but I'm going to teach you guys a proprietary-based trading plan where you can kind of surmise and guess what they're doing. So floor trader at the Chicago Board Options Exchange for 10 years, market maker in about 125 different classes, active trader in futures, forex, stocks, and options, regular contributor on CNBC. I have one trading account. This is my trading account, and I'll show you it real quick. So this year, I started the year with about $55,000 in my account. And I could actually show you, hey, what? I'm down $8,000 today. So today is a really bad day for me. A lot of my trades are not working out. But if you go to my year-to-date, I'm up $80,000 on a $55,000 account. So I've taken this account and taken it from $55,000 to $135,000 this year, trading what I'm going to teach you guys today. And throughout the presentation, you'll see this account move around because this is all real money. It's all my money, and I trade every single day. And I'm here to teach you something new and different that maybe you've never seen before. So active trader, mostly unusual option activities, regular contributor on CNBC. Risk disclaimer, put this in every single webinar. Day trading, short-term trading, options trading is an extremely risky undertaking. It is generally not appropriate for someone with little to no capital, no trading experience, or low tolerance of risk. If you buy call options, the most you can ever lose is what you pay for that call option. If you buy puts, that is the most you can lose. If you sell calls, you can lose a lot more. You sell puts, strangles, straddles, you can lose a lot more money. So just know it. Nothing is a holy grail system. And just remember, guys, you can lose money when you trade. I'm down money today. I showed you my account that I'm down $8,000. Never execute a trade unless you're willing and prepared to lose your entire investment. All trading operations involve serious risk. So what I'm going to teach you guys today is something new, which is outside of the realm that maybe you've never ever seen before. So you guys are all here for one reason and one reason only, and that is to make more money. I tell myself I'm very similar to Jim Cramer, where I say, hey, I'm not here to save the manatees. I'm here to make you guys money. I can teach you everything I've done in my trading career to make close to $5 million trading. And that's profits, not profits minus losses. So what I watch is paper, which is order flow, institutional order flow in the option market. So paper is an order from a hedge fund, mutual fund, retail bank, or trader. Throughout the course of the day, I watch somewhere between 8 to 1,200 trades a day. Then I put it into a trading plan that I will teach you guys today to figure out what are the best potential trades. So This started on the trading floor. Somebody used to have a piece of paper in their hand, and they say, hey, what is the order? What is on that piece of paper? So the brokers come into the pit and represent the biggest and best traders in the world. So I'm basically trying to mimic a trader's position. I'm trying to figure out who the best, biggest, smartest traders are in the world, and then I'm trying to mimic their positions. So who trades paper? Hedge funds, mutual funds, sovereign wealth funds, pension funds trade institutional order flow. Okay, I gave you that one in a call, guys. I'm buying some Alcoa calls right now. I just bought some Alcoa calls right now. So Alcoa, next week, 44.5 calls. I just bought some for 45 cents. We saw 6,737 in these traded. So the traders are hedge funds, pension funds, sovereign wealth funds, and mutual funds. It is important. Why is it important? Okay, it's important because these traders have information and technology that we do not have as a retail trader. That is why they're always getting in trouble for insider information. Mark Cuban, Phil Mickelson, Martha Stewart back in the day, Leon Cooperman, they're getting in trouble for trading on insider information. So there are two types of options in the world. Everybody makes it much harder and more difficult than it actually is, but there's only calls and there's only puts. So an institution can buy calls. They can buy calls as a speculation to the upside, or they can buy calls as a hedge against a short stock position. At the end of this presentation, I'll teach you guys how you know if they're buying calls as speculation or a hedge. Trader sells calls. They can sell calls against a long stock position, or they sell calls to establish a short stock position. Trader buys puts. They can buy puts for one of two reasons. They can buy puts for a hedge against a long stock position, or they can buy puts as speculation to the downside. Institution sells puts. They can sell puts against a short stock position, or they can sell puts to establish a long stock position. So this is everything that I'm watching throughout the course of the day. Trading options, people make it so much harder and difficult than it actually is. Trading options isn't that hard and difficult, okay? When you leave today, you'll have a concrete trading plan. You can take a picture of it. You can write it down of basically how to know how to read institutional order flow. So there's only two basically types of trades. We talked about this. There's calls and there's puts. A trader can either sell calls or they can buy calls. And this has never been back tested, but this is what I think here. Over the history of time, I would say if an institution buys calls, 40% of the time it's bullish. 60% of the time it's bullish, and 40% of the time it's bearish. If an institution sells calls, I would say it's 50-50. 50% of the time it's bullish, and 50% of the time it's bearish. Paper buys puts. 65% of the time it's bullish, 35% of the time is bearish. And you say to yourself, hey, Kev, I've read every single book possible. How is it possible if an institution buys puts, it's actually bullish? And the reason for that is the hedge funds have gotten much smarter in their old age. And they know if they buy puts, they buy stock. The synthetic of that is buying calls. Then you see institutions selling puts, 80-20. So if you looked at this and you said, wow, this is amazing. If you look and say, they're always bullish, right? So what kind of environment does this work in? This works much better in a bullish environment, okay? So it works much better in a bullish environment. What kind of environment are we in? We've been in a raging bull market for the since basically 2009, right? So this kind of order flow works great in this present time. Okay, so just keep that in mind, guys, that this is the kind of order flow that you want to take because we're in a raging bull market. If the market reverses and starts selling off, you'll just be tweaking it and trading more puts. But this order flow, what I'm going to teach you guys today, works best in a bull market. So there are institutions. The institutions are the mutual funds, pension funds, sovereign wealth funds. These are the whales. Most of the trades you see the whales make are hedges against positions. Okay, so you'll hear stuff on TV that they buy a bunch of puts in the SPY or they buy a bunch of calls in the VIX. Well, most of those positions are actually hedges against a long stock position or portfolio or basket. I just want to be right underneath these guys. Okay, I told you guys I'm going to teach you guys something different, something new, something fresh, and this is trading institutional order flow. I want to just be under these traders, okay? So I want to be under these traders, guys, and basically know that they're putting on these trades, and I can take advantage of this if I have a trading plan in place. So you must have a trading plan in place, and that's what I'm going to teach you guys here today. Then we have the hedge funds. The hedge funds are the sharks. Carl Icahn, David Einhorn, Leon Cooperman, okay? These are the traders have information to technology that we do not have as retail traders. So these hedge funds are the killer sharks, okay? They are putting on trades that are speculative trades based on research and information that we do not have, okay? So if an institution knew that a stock was going to go from $35 to $50, would they buy stock? The answer is no. They're better off buying calls because they're going to get a better ROI, return on investment. So throughout the course of the day, I'm watching the biggest and best traders in the world place and allocate anywhere from $10,000 to $5 million on trades based on information that they have, okay? I'll be completely honest, guys. I've made close to $5 million trading my trading career. I do not read news anymore. I do not watch, I watch NBC, but I only look for it for ideas, okay? You guys shouldn't be looking at news. You can go to Seeking Alpha. There's 500 articles why Tesla's going to go down. There's 500 articles why Tesla's going up. The only thing that matters in the world is what these institutions are doing. These are the insiders buying and taking positions, huge, massive positions in certain stocks, okay? In the option market, we just said that the option market is much more important than anything out there that you can read, okay? Because these people have information that we do not have as retail traders, okay? So what is the order process? An institution will come up with a trade based on research, information, and analysis. They will call the broker and they'll say, hey, we have somebody that wants to buy 7,000 Alcoa August 44.5 calls for 40 cents. Do you want to sell them any calls? So they will shop the order to Goldman, Citadel, Barclays, to see if they want to take a trade. Okay, the other side of what the institution is doing. Then the trade will go to the trading pit. Okay, once it's on the trading pit, it becomes a public order. So if they are trading based on insider information, I cannot get in trouble at all. They can get in trouble, but I cannot get in trouble at all because I am trading on what is known as a public order. Okay, so I am trading on a public order. Then it goes to the pit and it gets recorded for the OCC and the SEC. Does reading paper work 100% of the time? The answer is no. This is not a holy grail system. Nothing in life is going to work 100% of the time. Someone told you they had a trading plan that works for 100% of the time. I would basically run for the hills. Okay? So nothing works 100% of the time. But using this, you're going to put probability in math in your favor. Okay? And the reason you're putting probability math in your favor is you're trading on somebody else's idea. Okay? How many of you guys here have ever put on a trade and it worked against you? Sure, we all have, right? Most of you guys are probably not a CMT, chartered market technician. Probably most of you here are, not very good at reading charts. You just randomly choose what options to buy. Why would you take a random choice of what option to buy when you can trade something based on someone else's information? Okay? Trading, if you don't think that institutions have insider information, then you should probably, go to a different webinar. But it's a fact that institutions have information that we do not have as retail traders. That is why they're getting in trouble all the time for insider information. So this is a perfect example, and this is CIEN, okay? Institutional order flow. So somebody somewhere in the world bought CIEN May 25th, 26 calls for 63 cents. Let's break down the trade here. Somebody somewhere in the world bought the right, but not obligation, to buy 250,000 shares of CIEN between now and May 25th expiration. And for this right, they paid 63 cents. So the right, but not obligation, to buy 250,000 shares of CIN between now and May 25th on the 26th strike for 63 cents. It also shows where the stock was trading. The stock was trading at 25.20. Okay. Well, if you look, this is how much money I made that day. Okay. I made $8,410 that day. Okay, because I bought these calls and then the stock started going up. Okay. You can see here at that time my P&L was down $12,000. Okay. So at that time my P&L was down $12,000. This is the exact same account, guys. You can see the number on top actually. And you can see now my P&L is up $80,000. So since May, I've made $92,000 in this account. Okay. So simple and easy. Watching institutional order flow in the option market, guys. Okay. Seeing this order in CIN and then reacting on this order. How did I know this is a speculative trade? I'll teach you guys my proprietary based trading plan, how I knew this was a speculative trade. Next slide. Okay. So this is the secret sauce. This is what you guys have all come here for. This is what I watch throughout the course of the day. Okay. This is institutional order flow in the option market. Then I react and put on trades based on this proprietary based trading plan. Okay. So this is really important, guys. The next slide is probably going to be the most important slide of the day. This is known as the Oak Ribbit Trading Plan. OCRRBTT. So the first thing I look at is the option volume. Volume is how many options trade today. Open interest is how many options exist before today. So I want to make sure that the volume is greater than open interest. Okay, so volume is how many trade today. Open interest is how many they trade before today. So I want to make sure that the volume is greater than open interest. Then I look at the chart and I say, based on the chart, do I think this is a hedge against a stock position? Or do I think this is speculation to the upside? okay? Then I look at my R&R. This is your risk and reward setup, and this is something we're going to teach you guys on the master course is, you know, if you're buying an option for 30 cents, you're willing to hold it to zero, but you're trying to get 40 cents for it, that is not a good R&R, risk versus reward. So I want to make sure I'm getting a good R&R, risk versus reward setup. This is something, like I said, guys, we're going to go over for you guys in the master course. B is your break even on expiration. For calls, it's a strike plus the amount you pay for the calls. For puts, it's a strike minus what you paid for. Okay, where is your break even on expiration? Then we have TNT, time and target. If you're trading weekly options, they're going to have higher risk, higher reward. If you're trading longer dated options, you can give those a little bit more time. So where do you want to get out of a trade? When to get out of a trade, okay? R&R, some people like rest and relaxation. I do not. I like risk versus reward setup. Then we have TNT, time and target, okay? Where do I want to get out of a trade? And that is something we're going to teach you guys. That is based on a stock's ATR, average true range, and standard deviation ATR. Okay, those are something very important, and we're going to teach you guys how to get out of trades. Because putting a trade on is always very easy. It's taking it off is a little bit more harder and challenging. Okay. So you want to look at the volume. Volume's how many trades today. Open interest if how many exist before today. Okay, so I want volume to be greater than open interest. Then I want to make sure the chart lines up. If I see call activity, I want to make sure it is a bullish chart. If I see put activity, I want to make sure that it is a bearish chart. So I always want to make sure that that lines up with my trading. Okay? So always line the chart up. Then we have my risk versus reward setup. Okay, risk versus reward setup. How much I'm willing to risk on a trade versus how much I can potentially make on a trade. I'm going to buy some Alcoa calls right now at 38 cents. Just give me a second. I have to send this out. So here's a trade, guys. Okay, Alcoa. Next week, 44 and a half. I just paid 38 cents. So Alcoa next week 38. Next week 44 and a half calls. Okay, I just paid 44 and a half cents. This is a trade I just put money on, about $4,000 of risk. So this is Alcoa, August, 44 and a half calls for 38 cents. Okay, so this is a trade. I just put some of my money to work with in Alcoa. So Alcoa, I bought some calls here. Okay, so these are next week. 44 and a half calls. Just so you guys know, that's a trade I just put on. Okay. So then we have R and R. I know, okay, if I'm risking 38 cents, how much can I lose? I can lose $38 per 1 month. How do I want to have a proprietary-based targets? This is where I use my standard deviation ATR and my ATR. Alcoa moves $1.30 a day. Okay, the standard deviation is $1.28 a day. So I'll have started having targets $1.26 higher times the delta. The delta is 26. So about every 30 cents higher, I will have a target here in Alcoa. Okay, so that is my reward setup. Okay, so my risk and my reward. Then my break even. We talked about break even. That is going to be on expiration. So strike price plus the price I paid, strike price puts minus what I paid. You can use support and resistance levels. Time and target. Okay, time and target. How much time do you want to give this trade, and what are my targets of this trade? Okay, what is in the time of this trade, and what are my targets of this trade? Okay, it's so important to have this. Some trades might be 3 months out. Some might be weekly options. These are for next week, okay? So I have to be a little bit tighter on next week options than I am anything else. So I want to make sure my timing is right. I always personally take trades off before earnings, okay? So if I knew a stock has earnings, like FLS has earnings tomorrow, I want to be taking those off before earnings, okay? So always taking those off before earnings. Then my targets. This is something we're going to teach you guys. You can use this in any of your option trading. You're going to use standard deviation ATR times your delta, and also your ATR times your delta. Okay, so you're going to take a standard deviation times your delta, and then your ATR times your delta, and it depends on the expiration. Okay, it depends on the expiration. Something that is next week is going to have more risk than something that is so far, in November. Okay. So here's an example of DKS. So this is institutional order flow in the option market. A trader bought 2,880 DKS, Dick's Sporting Goods, March 32 calls for 75 cents. So somebody somewhere in the world said, hey, I want to buy DKS calls. How do they know what they want to buy? Well, they say, I think DKS is going to go higher based on my research and information. So this trade gave the trader the right, but not obligation, to buy 288,000 shares of DKS between now and March expiration. And for that right, they paid 75 cents. And if we look here and we went straight through the trading plan, is this the kind of trade that lines up? Okay. Well, the volume, so we go through that oak ribbit trading plan. If you guys did not take a picture of it, you probably should have. OCRRBTT. So the first thing we look at is option volume. Okay. So the volume was 2,888. The open interest on these was like 150. Okay. So volume was 2,888. Open interest was about 288. So yes, volume is greater than open interest. Once we know the volume is greater than open interest, we go to the next step of the plan. Next step of the plan is the chart. Okay, this was earnings. You can see it broke the Ichimoku cloud to the upside, and someone thought it was going to go higher. Okay, so volume was greater than open interest. The chart lines up. It's a bullish looking chart. Then you look at your risk versus reward setup. And let's say you took 20 of these. So you bought 20 of these for 75 cents. And we'll teach you guys proprietary-based stop losses. You're a beginner, using a stop loss here at about 35 cents. Okay, so your risk here was only 75 minus 35, which is 40 cents. On a 20 lot, it's $800 of risk. Okay. If you held this trade from when they bought them, you saw this trade, they bought them, and then you sold them on the high, which is $4, you could have potentially made, you could have turned that $800 of risk into 20 lot times $4 into $8,000. Okay. That is 10 times your risk on this trade. Okay. So not a bad trade at all. That is 600% gains, guys, in the course of 2 days. Okay. Using that proprietary-based trading plan that I taught you. OCRRBTT. Option volume greater than open interest. Chart bullish, broke the cloud to the upside. Risk versus reward. Okay, using a stop loss is okay. So maybe use a 35-cent stop loss. Then you let it run. Okay, you have your stop loss in place. You let it run. These calls went up 600% gains. Okay, and maybe you made 8,000. Took that 800 and 8,000. Well, look at how much the institution made. they made about $800,000, right? So I'm just taking a small fragment and section of what the institution is taking. Let's look at the next example here. Institutional order flow in the option market. A buyer of 3,754. BABA, BA, March, 200 calls, trade 25 cents. Okay, so the right, but not obligation, to buy 3,754 BABA, okay, March 200 calls for 25 cents. So let's go through our trading plan. Okay, this is so easy to figure out this trading plan. The first thing I look at is volume. The volume was greater than open interest, 3,754. Okay, open interest was way less than that. Then we look at the chart. Exact same thing here, guys. Okay, the chart, BABA breaking the cloud to the upside. So you could have seen this order and you said, hey, volume's greater than open interest. That's AK step 1 of the trading plan. Then you would have said, how does the chart look? Well, it's breaking the cloud to the upside. Hey, I can put on a risk versus reward trade here. So what can I do? I could buy some of these BABA calls. And let's say you bought 40 of these. Let's say you really like BABA and you bought 40 of these at 25 cents. I don't think there should be a stop loss at when you buy an option for 25 cents. It's just too hard to navigate and tell, right? So let's say you bought 40 of these for 25 cents. That would have been $1,000 risk, okay? And this is not my trade, guys. This is somebody's trade somewhere in the world. I'm just trying to follow the best traders in the world and mimic their positions, guys. I'm not trying to recreate the wheel here. What I'm trying to do is figure out who has researched information, technology that I do not have, and mimic their positions. So maybe, oh, they're coming in to buy more Alcoa calls. So maybe they came in and they bought these, okay? So the Alcoa, they're about to talk about Alcoa on CNBC. If you guys are in Alcoa, they're about to talk about Alcoa on CNBC. If you guys got in Alcoa where I got in, keep an eye on these. I'm raising my offers now. Give me a second here. Alcoa, guys, are about to mention it on CNBC. I just made $2,000 in front of you guys. Sorry about this. I need a second. I'm making money as we speak. I gave you guys these calls at 38 cents. They just traded 55 cents. I gave you guys these calls throughout the presentation, guys. Alcoa calls. So look at this, guys. I told you guys they were buying these, right? In Alcoa, I just made $2,300 throughout this presentation, guys. Okay? Institutional order flow in the option market. Alcoa, AUG 44.5. Okay? Volume 9,874. You could have bought these at 38 cents. They just traded 55. Okay, and you can see here, my P&L in Alcoa is now, wait, where's my Alcoa P&L? Alcoa P&L up $2,800. Okay, in the last 34 minutes, guys, that I've given this presentation, I just made $2,800. And I can teach you guys how you can do that. I flagged those for you. I gave you those. Okay? They're about to mention these on CNBC. Okay? And I'm going to make even more money in a second. Okay, so institutional order flow in the option market. Okay, watching the biggest and best traders in the world place and allocate trades and bets on certain trades. Okay. Here's an example of Citi, an institutional order flow. Watch this, guys. This is CNBC Live. You guys can see this. When the commercial's over, I'll show you. They're about to mention Alcoa. The Nigerian brothers that are on CNBC, I watch the same things they do. Okay? Keep an eye on this. Okay? So a trader buys Citi, March, 74.5 puts for 29 cents. Okay? So the right, but not obligation, to buy, to sell Citi at the 74.5 strike between now and March expiration. And for that right, they paid 29 cents. Okay? So someone said, hey, I think Citi might go down. So we talk about this working for calls and puts. Okay? Someone says, hey, I think it might go down. So they bought puts. Volume was greater than open interest. Then we look at the chart. It all lines up. Then we see that these puts went from 29 cents to $1.50. Okay? From 29 cents to $1.50. 500% gains. Okay? How would you like to have that trade? Not bad. Not bad at all, right? Let me just see where I have Alcoa calls offered. Okay? From 25 to $1.50. That's 500% gains here, guys. 500% gains in a very short period of time. Okay? Letter X, U.S. Steel, institutional order flow in the option market. A trader bought U.S. Steel. Bought U.S. Steel March 39 puts for 22 cents. So the right, but not obligation, to sell U.S. Steel on the 39 strike. For that, they paid 22 cents. Okay? Let's say maybe you got into some of these. Okay? Maybe you bought 30 of these. Okay? So you bought 30 of these for 22 cents. Here we go, guys. Look at this. Oh, you're talking about Celgene first. We're going to talk about, hopefully, Alcoa in a second. Okay. So an institution, let's say you bought 30 of these. You bought 30 of these for 22 cents. Okay. That's $660 a risk. That $660 a risk would have gone to $4,500. Okay. So $4,500 on this trade. That's $660 a risk. Okay? Simple and easy, guys. Following this institutional order flow in the option market. Okay? Placing trades where the institutions are placing trades as well. Okay? Going through that Oak Ribbit trading plan that I've just taught you. OCR, RB, TT. Volume versus open interest. Chart. Risk, reward, and break even. As you can see here, that we see the stock rolled over, possible short-term top, and it got down to about $38 here. Okay? So great trade here in U.S. Steel, buying the exact same thing, the institution. And you can tweak your strategy and philosophy. You know, maybe you'll decide you want to buy put spreads. They're just buying more Alcoa calls. Maybe you decide you want to buy put spreads. Maybe you want to sell call spreads. Maybe you want to do something different. In the course, we'll teach you all the different ways that you can take these trades based on insider information or institutional order flow. Okay. Here's another example. Oops. Let me see how many slides I've left. Okay, we got about 5 more slides. So you're saying to yourself, AK, why should I take these trades? What makes these trades so great? Okay. The hedge funds and big traders have more information than we have. That is why they're always getting in trouble for insider information. Okay. Just look at this, guys. Let me just show you real quick. I flagged these to you guys during this presentation. Okay, look at the timestamp on this. Okay, so I bought Alcoa, 44.5 calls for 38 cents. Okay, 38 cents I bought these calls. You can see what time. This was exact during the presentation. In 11 minutes, these calls went up to 55 cents. In 11 minutes, guys, they went from 38 to 55. That's about a 50% return here, and this is today, guys. Yeah, I can show you examples from a couple months ago. This is right in front of your eyes. I gave you guys a signal to buy these calls at 38 cents. If you took a 20 lot, you'd be up $350 in the last 20 minutes, just as I've been speaking. Okay, and this is why I watch institutional order flow in the option market. Okay, so the hedge funds and big traders have research, they have information that we do not have as small prop traders. Okay, do I care about Trump's trade policy? Do I care about anything? No. All I care about is institutional order flow. Okay, all I care about is, can I make money knowing that an institution started buying these calls? So the hedge funds and big traders have more information than us. That is why they're always getting in trouble for insider information. Okay, Mark Cuban, David Einhorn, Leon Cooperman, Phil Mickelson. Okay, imagine knowing David Einhorn, Carl Icahn's or David Einhorn's positions before they are disclosed to the public. Okay, we don't know who's making these trades, but somebody today has bought 11,000 Alcoa calls. Okay, that is a very, very big order, guys. Okay, someone has bought 11,000 Alcoa calls today. Okay, do you want to be on their side? Do you want to say, hey, I can place a little bit of money on this trade? Why? Because I think the stock's going to go higher. I think this trader knows something that I do not know. I want to put it on. Imagine if Carl Icahn, who I'm not friends with, I do not know Carl Icahn at all, said to you, hey, I'm going to put a big trade on an Alcoa. Do you want to get on this position? Well, I think you should buy the same calls as me. You would say, absolutely. I would be on in a second, right? So looking at this, using this trading plan, okay, can help you guys make more money potentially. Like I said, guys, look at Alcoa right here, okay? The stock is raging. I'm up $3,000 now since I started this presentation. Sorry, $3,100 since I started this presentation. Why? Because probably somebody knows something going on in Alcoa today. Don't know what it is, but the stock has moved up 60 cents since then. So the best thing about this, guys, are all these trades are public orders. Every single one of these trades are public orders. Here's an example in C-Trip, institutional order flow in the option market. Okay, a trader bought CTRP, March, 49 calls for 20 cents. Okay, this was also the day after earnings. Somebody somewhere in the world decided to buy CTRP, March 49 calls for 20 cents. Okay, the right, but not obligation, to buy, I think it was about 2,000 of them, so 200,000 shares of CTRP between now and March expiration, and for that right, they paid 20 cents. Let's say you bought some of these. You saw this signal, you went through the trading plan that I've taught you guys today, and you said, hey, I can take some of these trades. I'm going to buy 30 of them for 20 cents. 30 of them times 20 cents, another $600 of risk. I think a lot of you guys, if you like to trade, you could risk $600 on a trade. I would assume, right? So that 30 lot of $600 of risk went to $3,600, okay? This is real money, guys. This isn't monopoly money. This isn't, something that's not real, okay? Like I said, I am up $3,000 in Alcoa right now. Okay, and I've only sold part of my position. I still have some of them left. Okay, summary and key takeaways. Reading paper does have its limitations, and this is not a holy grail system. I'm not going to say if you take every trade that the institution takes, you're going to make money. Call buying is not always bullish. Put buying is not always bearish. Bulls can't bluff selling puts. Large paper and unusual volume will help put probability and math in your corner. If you guys are not if you're figuring out why you cannot make money, there's a reason why. You're coming up with your own trades yourself. I am not coming up with any of the trades myself. I'm watching the biggest and best traders in the world place and allocate capital on trades. Then I pick and choose which trades I want to take. Okay, for example, today, Alcoa is the only thing I've taken today. I actually took win put spreads, but Alcoa is the only calls I bought all day. The only calls I bought all day, and I'm up $3,300 today, guys. Not bad. Large paper and unusual volume will help put probability and math in your favor. Okay. If you guys have tried everything else before in the past, try something different. Try something new. Okay. This is very unlike anything else. Okay. This is following institutional order flow in the option market, mimicking the best traders in the world. Remember the oak ribbit trading plan. Volume greater than open interest. Chart, risk and reward. Break even, time and target. No trading plan is without losses, and if someone tells you you're going to make money all the time, I would run for the hills. Because every trading plan will have some losses from time to time. Okay, I have losses. You know, I'm down today actually. Alcoa really helped me here. I'm up $3,000 in it, but I am down today. This is how I made close to $5.5 million. I made almost $1 million in Apple for 2 straight years. How do you find these trades? We're going to teach you guys how to do that in the course. Okay. There's certain people on Twitter that you can follow to get these trades in real time for free. Okay. I've traded almost 1 million equity options and 40 million shares of stock. Stop guessing, guys, and start making money with an active trader who trades every single day. Okay. On a busy day, I could trade almost 1,000 options. So I trade a lot, and I'm very aggressive, and I just watch for these trades. But you can see today, guys, if you go to my notes tab and you go to my filled positions, all I've done today is Alcoa, and I sold some win put spreads. Okay. And they might mention again here on CNBC. This is what you're going to learn in the unusual option activity course. You're going to master the oak ribbit trading plan in much more depth. Why volume versus open interest is so important. Okay. How we dissect the whole option chain for one trade. Why mimic the institution trades. Different trades for different traders. We're going to show you how one bullish signal can be used to buy calls, to sell credit put spreads, to buy call spreads, or to buy call flies. Okay? How I use stock volume versus option volume. It's very, very important because 10,000 Alcoa calls is a lot more meaningful than 10,000 Apple calls, okay? Because it trades a lot less stock in the day. Figuring out an exit strategy or exit plan in a no blowout trading plan, okay? Using stop losses. This is everything you guys are going to learn in the course, okay? Just think about what you could have done if you took the trade that I flagged to you guys today and you made $3,075 today. What would you do with an extra $3,000 that you just made in 30 minutes? Pay off student loans, maybe go to a nice dinner, buy your significant other something. Think about what you could do with that money, okay? Like I said, guys, this is all real time and live. How I determine which trades I risk and picking the best trades with the best probability. Learn the secrets that Goldman Sachs doesn't want you to know from a floor trader. Okay, I traded on the trading floor for almost 10 years. I'm about to sell more of these for 65. Okay, so this is the unusual option activity workshop. It is optionsonthefloor.com/hot. Okay, so the unusual option activity trader workshop. Okay, this is everything we're going to teach you guys in the workshop. How to dissect the whole option chain. Master the standard deviation ATR and ATR for the best possible exits. How to potentially add to a losing position. Yes, it is okay to add to a losing position. What will spreads iron condors? Yes, we'll teach you all this in the workshop. Okay. Learn a confidence scale and master course. So we just broke this down. I try to give you guys 10 times your money on any time I give a webinar. Okay. So these are $199. These are all $199. The course we sell on our website for $9.99. Okay. Learn a confidence scale. You're going to get it on demand plus one live bonus session. We only have 25 spots available, guys. Okay. We only have 25 spots available, and we're offering it to you guys for $97. Okay. In any of these presentations, I try to give you 10 times your money. This is over a $1,400 value. So make sure you guys sign up. If you want to get these trades like Alcoa, then now I'm up $3,400. Okay. You can sign up at optionsonthefloor.com/hot. Okay. Options on the floor, because this is hot. I'm actually up, now I'm up over $5,300 in Alcoa. I have them in two separate accounts. Okay. So this is optionsonthefloor.com/hot. This is the unusual option activity course. Okay. This is everything you'll learn. It's a $1,499 value. Okay. I see people signing up. I see Chad is in. I see JJ is in. I see Alan is in. I see Adam is in. I see Raph is in. I see Barbara is in. You only have 25 spots, guys, so make sure you sign up. It's only $97. You'll get it on demand with that bonus live session. In that bonus live session, we're going to teach you guys where you can get all these trades. Okay? It's a $1,499 value. If you guys have any questions at all, I have about 2 minutes of questions here. My inbox is blowing up here. Ryan is in. John is in. Deborah is in. We only have 25 of these guys. It's optionsonthefloor.com/hot. Okay, this is everything you're going to learn. How to dissect the whole option chain, okay, at once. Master a better exit strategies. Okay, Pete and Jerry might be talking about Alcoa right now, so keep an eye on this one. They're doing their final trade here. I want to watch this for a second. If Pete and Jerry mentions Alcoa, then I'm going to make more money here. We'll wait. Okay. So how did I dissect the whole option chain? Mastered ATRs and standard deviation ATRs for the best exit strategies. How to add to a losing position. Yes, it is okay to add to a losing position. How to earn a confidence scale and avoid blowing out your trading accounts. Okay. It is on demand. Plus, you'll get one live bonus section where I'll show you how to get all these trades. It is available only for the first 25 students, guys. Okay, $97, potentially make money like I just did in Alcoa. Okay, I gave it to you during this presentation. $3,397. Oh, they just mentioned Alcoa. I just made more money. Okay, so now my P&L is up to $3,500, and I actually have this in two accounts, and I'm up $2,100 in this account. So I'm up $5,700, guys, during this presentation. We only have a couple spots left, so make sure you guys sign up. It's optionsonthefloor.com/hot. If you want to potentially make money like this, okay, you have to sign up. All right, everybody have a great day. Right on time. Gigi, it's all yours. Thank you so much, and I'll see everybody later.